All right, day 12, section 3 here. So let's talk about how, kind of some more mundane details about how monetary policy tools work in practice. And then we'll talk a little bit about the 2008 financial crisis as it's kind of a case study and how the Fed uses their three tools here. So let me switch over. Oops. Okay, let's talk about open market operations first. All right, and once again, now we're just going to kind of talk about the more mundane or detailed information about how open market operations work. In practice, there's two types of open market operations that the Fed does, dynamic or defensive. What is a dynamic open market operation? It's intended to permanently change the monetary base, right? So when the Fed conducts a dynamic open market operation, it's a permanent change. They're trying to aggressively change the federal funds rate. So this is usually when the Fed changes the target, they will conduct a dynamic open market operation. And oftentimes this means an outright purchase or sale of treasury bills. This is different from when the Fed conducts what's called the defensive open market operation. And a defensive means the Fed's not trying to change its target, it's just trying to hit the target, right? So for instance, if the Fed has a target of 2% for the federal funds rate, but the interest rate has ticked up to 2.1%, the Fed then is just going to want to try to drive it down a little bit back to its target. It's going to want to conduct a defensive open market sale to try to drive, a defensive open market purchase to try to drive that interest rate from 2.1% down to 2%. So a defensive open market operation means they're not changing policy, they're just trying to maintain policy and offset fluctuations. And there's all sorts of reasons why the federal fund rate fluctuates from day to day, right? It could be weather, it could be the season, like for instance, during tax season, there's a lot of withdrawals from the Fed, right? As the federal government pays people their tax, right? If they had a tax surplus, it pays it back to them. They get a refund, it gives them back to them. The weather, I mean, I'm sure that there's just a ton of volatility associated with the pandemic as people change their transaction practices. So, that's what we mean by a defensive open market operation, kind of maintaining the target as opposed to a dynamic open market when you change the target itself. Oftentimes, defensive open market operations are conducted by what's called repurchase agreements. And by that, I mean the Fed doesn't even permanently buy or sell treasury bonds. They do it for a day, 2 days, right? So the Fed could conduct a temporary open market sale or a repurchase sale, right? Where the Fed is going to sell the bank bonds for 2 days, and then it's going to buy it back at the end of those 2 days. So what the Fed is doing is just changing reserves just for 48 hours or so. And the Fed does that a lot, right? Because they're just trying to tinker with the money supply in an effort to keep the federal fund rate at its target. So, the day-to-day goal is you maintain what that federal funds target is. If the federal funds target is below, you must reduce reserves and conduct open market sales to drive the federal funds rate up. And if the federal funds rate is above its target, you must increase reserves and conduct purchases to drive the federal funds rate down. In practice, all of these trades are conducted electronically with primary bond dealers in New York associated with the big banks. This is very efficient, very liquid because treasury bill markets are huge, very easy, and it's very cheap, right? So the Fed is very, very good at doing this. And that's one of the reasons why the Fed uses open market operations, right? It's easy to control, it can be done quick, it's flexible, it's precise. The Fed has great control over this. I mean, in theory, the Fed could buy or sell anything. They could buy or sell Star Wars action figures on eBay if they wanted. But you can see the problem, right? That the Fed's not going to have perfect control over what Star Wars action figures are available on eBay. It's not going to be flexible. It's not going to be precise. Those markets are not very liquid. It can't be done quickly. I mean, so while in theory the Fed could buy or sell anything, in practice, T-bills are the perfect thing for the Fed to buy and sell. And that's why this is the primary way that they control the money supply. Let's talk about the other two tools that the Fed could use to change the money supply. But in practice, they don't really use these, right? One is to change discount policy, meaning they're lending to banks. The Fed could do that by changing the discount interest rate, or they could change its administration. In other words, they could just make it easier for banks to borrow money. So the Fed can encourage banks to borrow from them without changing the interest rate, by just telling them that they're not going to have to jump through all the hoops that they usually do to borrow from the Fed. In practice, the Fed makes different types of discount loans. Adjustment credit, which is really to banks with short-term problems, right? This is very rare, right? This is almost so rare as to almost be non-existent, right? In general, only during a financial crisis will the Fed use adjustment credit, right? Extended credit is even more rare. This is to banks that have liquidity problems, but they need to be lent money for longer periods of time. During 2008, the financial crisis in 2008, the Fed did make some extended loans to banks to help facilitate mergers. But now these types of loans the Fed can't even give these anymore, right? We talked about in the Frank-Dodd Act that the Fed's not allowed to lend long-term to banks anymore. And so it's going to have to be a pretty unusual circumstance for the Fed to offer extended credit in the future. The Fed does offer some what they call seasonal credit programs. This is to kind of small banks that are in areas where their business is very, very seasonal, such as if you're a small agricultural bank, or if you're a bank in a vacation area where your business boom and busts. The Fed does try to help these banks a little bit by providing seasonal loans. But that's, in general, that's so small a part of what the Fed does that it's really unimportant. Remember, in general, the Fed does not use discount lending on a day-to-day basis to manage the monetary base and the federal funds rate, right? This is only during emergencies as a lender of last resort. So the Fed does not do this on a day-to-day basis. And one of the reasons why is, well, I guess there's a couple of reasons. One is that who knows how much banks want to borrow from you in any given day, right? You can imagine it'd be very difficult for the Fed to control the money supply if they had to rely on banks coming to them for loans, right? Because some days banks might show up with lots of loans demands, and other days they may not have any. So, the Fed doesn't want to rely on banks when it comes to what they're doing with the federal funds rate. But I think the even deeper problem is the Fed doesn't want to lend to banks too much because they're worried about moral hazard, right? They're worried that it sends the wrong signal to banks that they can just borrow whatever they want and the Fed will bail them out. So the Fed only really uses this in extreme emergencies. Some people have said, well, why doesn't the Federal Deposit Insurance Corporation serve as a lender of last resort? Why do we need a central bank to do this? And quite simply, the fact is that FDIC is not nearly big enough, right? They have a fund that only amounts to about 1% of all deposits. So it's not nearly big enough to support the massive amount of deposits that exist out there. The FDIC only insures up to $250,000. So, big depositors could be spooked too if it was just left to the FDIC because they would think that there's no lender of last resort for them. So, in practice, having a central bank to serve as a lender of last resort is a crucial thing in modern financial systems. The last tool that the Fed could use to change the money supply would be to change the required reserve ratio. If the Fed, for instance, lowered the required reserve ratio, that would create excess reserves that would increase the money supply, but it would also change the money multiplier that would increase the money supply. So the Fed, in practice, could use the required reserve ratio, move it up and down to move the money supply. It could reduce the required reserve ratio to increase the money supply. It could increase the required reserve ratio to cut the money supply. However, this is a very, very ineffective way to control the money supply. It would lead to very big, unpredictable changes in the money supply. And it also would be really costly for banks for them to have the amount of excess reserves they have to meet every day going up and down, right? It would be very, very difficult for them to manage that. In general, the central banks don't like using this, right? They just don't, because it's just a very costly way and unpredictable. And remember, these are a bunch of bankers, right? They want to do things very conservative, very predictable. They don't want any big changes. And, you know, the required reserve ratio doesn't really meet those objectives. What is the required reserve ratio in reality? Well, it depends upon the bank. The Fed can set the required reserve ratio, but typically in the US, banks pay 0% required reserves on their first $15 million in deposits. Then they pay 3% between 15 and 115. Then they pay 10% on anything over 115 million. So in practice, most banks have much, much more than $115 million in deposits. So most banks are basically paying 10%. The Fed can vary this though, right? Up to 18% in an emergency. But as I said, the Fed really doesn't like to change this required reserve ratio around. So it pretty much has stayed the kind of the break or the cutoffs have changed, but this same basic rate structure has existed for at least 20 years, and the Fed is very reluctant to change it. Let's talk here briefly to finish up our today's discussion about some other tools that the Fed has used, right? So outside of required reserves and open market operations and discount lending, are there other things that the central bank could use? During the 2008 financial crisis, the Fed did try different things. They tried new lending programs, right? So the Fed didn't just lend to commercial banks. They lent to a lot of financial institutions, including investment banks, in part because they decided that many of these big financial institutions were not only too big to fail, but they were too interconnected to fail. So if some of these big places like Bear Stearns went down, it would take a number of banks with them. So, that was something new for the Fed. And this is actually something the Fed's not allowed to do in the future under Dodd-Frank, quite honestly. The Fed used it in an emergency of 2008, but the worry with doing this is this too big of a fail thing, right? The worry is that it creates too much moral hazard. And so, kind of the handcuffs have been put on the Fed for doing this in the future. What the Fed kind of has switched to in 2008 and definitely has been relying upon more during this pandemic crisis is doing asset purchasing programs. Instead of just buying T-bills like they usually do with open market operations, why don't we buy other kind of financial assets like mortgage-backed securities, commercial paper, money market assets, and try to increase liquidity in the financial markets in general, not just in the banks. This has been very successful, and the Fed has continued this. During the pandemic, the Fed has been very aggressive in buying up a lot of money market assets and T-bills in an effort to try to stabilize markets and make sure that there's not any big panics, right? Make sure there's enough liquidity. Here you can see the huge spike in the size of the Federal Reserve's balance sheet, right? That the Fed basically quadrupled the size of the assets that they owned during the financial crisis. And it's going to be fascinating to see what happens here as we get out to 2020, because the Fed has at least bought another $1 trillion more assets that we know of, right? They bought another $1 trillion more. So the Fed has greatly expanded its balance sheet. But you can see largely what the Fed did was there's a huge jump up in 2008 that kind of lasted to 2014, and then the Fed was flat. And what we're going to see going out here in 2020 is there's going to be another big jump up and probably also a continued increase in the Fed's balance sheet, hopefully a flattening. as the Fed kind of backs off that when we no longer need it. One other policy that the Fed used is often called forward guidance. And by this, we meant that the Fed tried to shape expectations by telling the public what their policy intentions were for the foreseeable future, for the long time in the future, up to 18 months. So in general, the Fed really only kind of tells the public what they're thinking about for the next 6 weeks. But the Fed said during the crisis that they were keeping interest rates low and they were going to keep them there for 18 months. So basically what the Fed was trying to do is give people some sense of confidence and try to reassure them about risk by saying interest rates are going to remain low for a long period of time so you don't have to worry. And that was a new thing too. So, new lending programs, new asset purchasing programs, forward guidance. Those were some of the new things that the Fed tried during the crisis. And did they work? Well, yes and no, right? I mean, listen, I don't think any reasonable economist thinks that what the Fed did didn't help the economy. Undoubtedly, it helped the economy a lot. Or was it enough to prevent a crisis? No, because listen, ultimately the powers of the Federal Reserve are limited, right? Some economists have used the analogy that during times of panic, central banks, all they can do is push on a string, right? They're pushing, they can print money, print money, print money. But when people are too afraid to spend, too afraid to lend, the Fed can print all the money they want and drive interest rates all the way down to zero or even negative, as we're going to see in a minute. People just still won't engage in economic activity. So, while I think what the Fed did prevented, a huge collapse, right, or something much worse, prevented a depression, monetary policy by itself is not powerful enough to isolate us from the economic consequences of financial panics. Some central banks have even pushed interest rates negative, right? And if you think about that, that is a bizarre world. We've talked about negative interest rates before. This world in which you put money in the bank and you have to pay for the right to save money, right? Sweden and Denmark, and the European Central Bank in 2014, Japan in 2016. There's been some talks about the central bank pushing interest rates negative. The goal is if you push interest rates negative enough, people don't want to save, they just want to spend, and maybe that will stimulate the economy. But the problem is that people can still just hold cash. And now holding cash is even worse than having money in the bank. Or at least if money is in the bank, there's the potential it could be lent out, as opposed to people just pulling cash out and sitting on big hoards of it. Negative interest rates are a sign of a very sick economy. And so, thinking about the US, should the Fed today be thinking about negative interest rates? They're very reluctant to do that. And I'm kind of with them on this, that negative interest rates, first, it's not really clear that it's the huge stimulus that it could be. But second, it really kind of sets the stage for financial disintermediation, for people to pull their money out of the banking system, and they may never put it back in, even when the crisis is done. And so in an economy like the US that is so financial intensive, right, for lack of a better word, it really, for me, brings up the worry that it's going to create a lot of incentives for people to begin to pull money out of the US financial system, something that won't serve us well in the short run, but also in the long run. But other banks have tried it, and based on the evidence I've seen, there's really no evidence that it works well. It is, though, clearly a sign of a very sick economy, right? When you have negative interest rates, something is not going on very well in your financial system. So, all right. Hope you're all well, right? Hope everything's going fine. Be safe, be well. That finishes up day 12. We will have our exam tomorrow on day 13, right? So next time you get some lectures will be day 14. Okay, see ya.